Now, we did talk about how the GFC has been affecting banks. However, what's really interesting for us is, of course, how it's affecting our real life. And there's a lot of data and a lot of theory about it, but I think this picture is saying a lot already. So on this picture, we have two people. We've got Treasury Secretary Henry Paulson and Fed Chairman at the time, Ben Bernanke. Ben Bernanke has been an expert on the Great Depression, especially in regards to financial crisis. Henry Paulson was a former CEO of Goldman Sachs before he changed over to the Treasury Department. What these two have in common is that they're both insiders. They've got a lot of knowledge about financial crisis, and not only about financial crisis, they have access to data about banks that we or other people do not have access to. Now, in this picture, they're trying to convince politicians how serious it is. And in my opinion, the picture tells you everything already. So these two would not look that desperate if the financial crisis was just a small crisis with no serious impact. These two were really worried that the economy is going to crash absolutely. Now, why is that important? There was a big discussion of Main Street versus Wall Street. Wall Street are, of course, the Wall Street bankers, and they had been indulged in securitization and high profits beforehand. Main Street stands for the small guy and small corporations, mom and dad business. So the question is, why should mom and dad taxpayers bail out the rich banks? And the reason is because otherwise we are all doomed. How can we see that in the data? So we already know that interest rates between banks went up because banks didn't trust each other anymore. However, not only interest rates between banks went up, we can see here spreads. That means how much more do these corporations have to pay in excess of the government bonds. And we can see here low-risk corporate bonds in the past had to pay hardly more. The spread, so the risk premium, was under 2%. I roughly estimate this one to be 1%. Triple B, very low as well, around 2%. High yield means high risk, so they had to pay a higher risk premium, around 4%. But now let's check what happens here at the start of the GFC. So the spreads just went massively up. Especially look at this one. This corporation here had to pay 16% more than the government to attract finance. And you can imagine that's not going to be good for business. And we can actually see the real impact here. So the American economy was growing well during 2005, 6, 7. But in 2008, it was not only growing, it was shrinking. This is something that happens very well seldomly. And usually it's shrinking, if at all, around 0%, just tiny bit under zero. And here we can see clearly under zero, minus 2%, minus 3%. So that was a very big dive for the economy. GDP was reducing instead of increasing. We can see that in other numbers as well. Unemployment rate. In the US, usually fairly low. You can see here 4, 6%. Then during the crisis, a massive spike. So companies have less access to finance. Companies become very pessimistic about the future. They don't want to produce anymore, or they cannot produce anymore because they can't get finance from the banks, which are impaired themselves. So they let people go. And the unemployment rate went massively up. Long-term unemployment. A much bigger problem than short-term unemployment. So this is a percentage of unemployed people that stayed unemployed for long periods of time. That used to be small, less than 20%, and now went up to over 40%. Long-term unemployment is a much bigger problem. You can imagine if you're unemployed for 1 or 2 months, you don't have to sell your house, your life goes on. It's just a little ding in your CV. However, if you're long-term unemployed for numerous months, you lose your human capital. Also, when you apply somewhere else, people might look funny at your CV if you've got a massive gap in your CV. You might get depressed. You might lose your house because finance is now becoming really short. So long-term unemployment is a real major problem. And it's called global financial crisis for a reason. So we can see here the equity indices, basically share market indices. All the other countries around the world took a massive dive too. So they all normalized here around 100% for starter, And what we can see here is how far they went down. In the case for Canada, minus 40%. Even here for Europe, Japan, basically all of them took a massive dive. Almost half of the value was lost. In the meantime, it recovered again. However, you can see it took a prolonged period of time to recover. And that problem was not only there for the developed world, the less developed countries suffered just as much, if not even more. Here, down from 100% to 40%. So Latin America, the emerging Asia, all of them got into massive troubles. How did it look like for Australia? So Australia is a bit the lucky country, but even here we have an impact. So you can see here the non-performing assets. So we're on the asset side of banks, and these are basically the share of loans that got into trouble. Everything was fine, under 1% here before the crisis. Once the crisis hit, more and more companies got into trouble, especially businesses. So you can imagine these might have been businesses that had production and intention to sell goods for overseas, and now since the overseas markets collapsed, they could not sell their products, got less income, got into financial trouble. Similarly, however, for domestic businesses, people see on TV the global financial crisis. They see that the global economy is in massive trouble. So they are not very intent to get a loan to buy a new car, to get a loan to get a new fridge, or to spend money all up. More people start saving. And if more people start saving, businesses can't sell their goods and businesses might get into trouble. Side note, that doesn't mean that saving itself is a bad thing. It just means that sudden changes in the savings rate can be bad for the economy. In summary, we had a boom-bust cycle. So initially, we had a lot of moral hazard and ignorance of the investors. Banks were happy to grant loans and mortgages to people that shouldn't actually get mortgages. They repackaged these as mortgage-backed securities. People were happy to buy these mortgage-backed securities, and we had more and more mortgages and money in the market, and therefore a credit-fueled asset price inflation or house price inflation. In the end, that thing was unsustainable and the bubble burst, taking the whole financial system down with it. Global banks were linked with each other, and therefore the crisis spread around the globe within no time. Without healthy banks, no economy can work, because many businesses are relying on bank finance. And even with healthy banks, like in Australia, the reduced world demand is causing havoc for the real economy. So there you've got it. The global financial crisis might have started in the US, however it spread across the globe quite fast.